The Minister of Finance will this week table the much anticipated budget. Since the October M2PS, the growth outlook has improved following the third quarter GDP data, which surprised the market to the upside. And more interestingly has been the performance in tax revenue collections. We see that with the year-to-date performance, it suggests that tax revenue is likely to be better than M2PS by about 100 billion. So that's definitely good news. And at the back of that, we think that will also bode well for the medium-term expenditure framework in terms of the revenue outlook. So we also do expect that Treasury will revise the revenue numbers upwards for the next coming 3 years. So that's definitely, some good news and a sigh of relief that things have not deteriorated since the October budget. And then in terms of issuance, from the issuance side, is there equally good news?
Yes, well, I mean, the revenue overrun does play into the issuance story, but besides the revenue overrun, we've also had a Treasury issue around 96 billion more than it needs from a deficit perspective in domestic local currency bonds. So when you combine that with the revenue overrun, plus we've have issued a bit less on the foreign loan side. So in terms of dollar bonds, hard currency bonds, we've issued around 30 billion less than budget. Overall, this means that we've got around 143 billion in cash that is not that we don't require in terms of financing the budgeted deficit. So that's a fantastic position to be in for Treasury. It gives us a lot of liquidity and optionality. But unfortunately, it's come at a huge cost. So we issued that debt at a discount rate of 0.9, which means that for every 100 Rand that we've issued, we've only got 90 Rand back in cash. So it's been very expensive for us to raise that additional debt and to be in this position. But it does mean that we have that optionality. And I think when we look at the budget, we're going to need that optionality. If we look at how we can reduce issuance, I think that you can take us through those implementation risks that mean we may not be able to cut issuance as much as the overfunding suggests.
You're totally right, Kim. I think what we're most concerned about, particularly on the expenditure side, is the uncertainty around the wage agreement. So the wage negotiations, which will determine the wage adjustment for the next 3 years, those negotiations haven't started. So which indicates that there's high implementation risk around National Treasury's wage freeze assumptions. From our side, we think that a partial wage freeze is more likely. Where lower level employees will get an inflation adjusted increment on their wages, and then the higher level employees will get an outright wage freeze. So that still does indicate that there will be some slippage on the expenditure side. And then we also have to take into consideration, as you pointed, that the overfunding has come at a cost, and that means higher debt service costs also. There's also the question around SOEs, which may require further funding, which definitely pose a lot of high implementation risk in terms of executing the budget numbers. So, I think you're correct to be cautious around the extent to which National Treasury can cut issuance.
Yeah, our estimate from the numbers shows that we can cut around 2.7 billion per week in the upcoming fiscal year, and still hold on to that 143 billion in cash. So I think the market, local investors have started to position themselves for a positive budget, for a reduction in issuance. And what we've seen though is markets have been choppy heading into the budget because of rising international interest rates. So you've had these countervailing forces. Our debt-to-GDP rising, and we think that could rise to over 100% in 23-24. So that pushing upwards on yields, combined with global inflation fears and US Treasuries rising, and that upward pressure on yields being countered by our local story of issuance reduction, is making for a very choppy market. especially in low liquidity. So at the moment, the markets are not very liquid. So it means any buy or sell requests from investors is moving the market more than it would usually. So we are seeing a lot of volatility, and I think that's going to play out for the rest of the year.